Hi everyone. Okay, so now we're going on to 6.3, which is taxes. And so we're at the end. This is actually the last lesson that we're going to learn in chapter 6. And taxes is an important lesson for you to understand. And you may need to watch this video a couple of times to make sure that you've got it down. Okay, so let's get on with it. So the first thing I want you to do is I actually want you to pause this. And I want you to go through and identify all the different kinds of taxes that you know about. Maybe ask a parent, a neighbor, a grandparent. I want you to go and ask people, what kinds of taxes do you know about? So for instance, I'll start you off. A type of tax would be property taxes. Okay? And if your parents own a home, then they would be paying property taxes a couple times a year, or it would be paid through their mortgage. So go and ask or figure out all the different types of taxes that you know about. All right, once you've got that done, we're going to move on. I'm going to check tomorrow too to make sure that you've got all your different types of taxes listed there. So what we're going to be talking about in this course is we're going to talk about sales taxes. And these are the taxes that you're probably most familiar with. So when you go to a store and you pay $10 for a new water bottle, okay, are you only going to pay $10? No, you're going to pay this much. You're going to pay $11.30 and is the total, including something that we call HST. And the HST amount is $1.30. So we now, if we're going to be accounting for businesses, we need to understand, how do I account for this $1.30? How do I do accounting for this? And so accounting for taxes can be complex because there's lots of government regulation. So we're going to learn how to do that right now. So we're going to be talking about just HST. And HST stands for Harmonized Sales Tax. And so anybody who knows music knows that harmony is the combination of two or more things, right? A harmony. Two or more voices. Harmonized sales tax is two different taxes. So let's give you a little bit of history. Harmonized sales tax is the percentage tax based on the price of a good or service. Just like I mentioned, the water bottle, we're going to add 13% onto that. So the current rate in Ontario is currently 13%. So you're going to remember that number. That's an important number. Harmonized means that the provincial and federal rates have been combined. So a portion of this is federal and a portion of this is provincial. So let's look at a bit of history. Any business that has sales greater than $30,000 per year, so revenue or sales revenue is greater than $30,000 a year, must register for HST and must collect HST on any sales that they make. And at the end of a period, they must remit those, or submit that HST they've collected. They must submit it to the government because it's not their money, it's the government's money. So let's talk about the history of HST. So HST came into effect in Ontario on July 1st in 2010. Before that, it was prior to July 1st, consumers were charged 8% PST and 5% GST separately. So on an invoice, you would see both taxes separately. So the HST is provincial. Okay, it was collected provincially, and this stands for provincial sales tax. And the GST is called a consumer and services tax, and it was collected federally. So this money goes to the province of Ontario, and this money goes to the federal government of Canada. And so in 2010, they harmonized that. So rather than being charged two different taxes and making businesses keep track of two different taxes, they harmonized it. So now HST is 13%, but it includes that federal portion and provincial portion, but we don't have to account for it separately. So this was to make things easier for businesses. So what do we pay HST on? Well, you probably paid HST on food, on clothing, on your entertainment, when you go to the movies, on your gas. If you want to find out more, you can go to this website. So HST requirements. So businesses, if you're in business, you're required to do the following. The seller of the business is charged with the responsibility of administering the tax. So collecting the tax from the customer. So here are their responsibilities. They must calculate the tax, or they must have the cash register calculate the tax and add it to the price of the goods, which is what you see happens at the cash register when you buy something. The next thing they must do is they must collect it from customers. So in your case, you would pay the business the $11.30, and the business is required to accumulate all of that HST, all of the 13% into a special account. And that special account is a new liability account called HST payable. And then at the end of a remitting period, they must accumulate the sales tax and remit it to the government either monthly, quarterly, or annually, depending on the company's annual revenue. So the government's going to tell you, your business, how often you need to send in that HST to the government that you owe. So one important thing here, HST payable is a liability. So even though we got the money from the customers, it's a liability to us because we don't own that money. The government does. And so we owe that money to the government. This sounds like a great true and false question, so make sure that you really understand that. HST that is collected by the business is held in a separate account called HST payable. It's a liability, and it's a liability because we owe that money to the government. That sounds like a great question, just FYI. So how do we record HST on a cash transaction? So let's say you're a business, you make a cash transaction, and it turned me off. The accounting entry for a cash sale will look like this now. So we're going to still debit the bank. So in this situation here, we've made a sale. So we sold an item. So sold, let's say, I don't know. We sold a phone, a cell phone, okay, for $199 plus HST. When we calculate that, total is $225. So the business is going to debit their bank account $225 because that's what they collected from the customer. They're going to credit their sales or their revenue, whatever their revenue account is called, and then they're going to credit HST payable for the HST amount. This is calculated by taking 199 and multiplying it by 13%, and that's how I get that $26. The amount of tax can be read off of the cash sales slip, the source document, or the point of sale summary. So that's how the business is going to record that for each transaction. Debit the bank, credit revenue, and credit HST payable for the amount of the HST. Now, what happens if a sale is on account? So someone buys something from you, but they don't pay right away. The transaction is the same, except we're going to debit accounts receivable. So in this case here, someone was buying, let's say they were buying some new skis, okay, for $321.75 plus HST. When we multiply that by 13%, we're going to get $363.58. The HST portion is calculated by taking the purchase price and multiplying it by 13%, and that's how I get that $41.83. So again, the transaction is exactly the same as the cash sales, except now we're debiting accounts receivable instead of cash. The HST payable is actually exactly the same. So even though we haven't received the money yet from the customer, we still set aside that value in our liabilities as money we owe to the government. the amount of the tax can be read off of the sales invoice. So when we have an accounts receivable where we're selling something to a customer and they're not paying right away, that source document is a sales invoice. So then we have this other situation. So businesses have to buy supplies, and they have to buy equipment, and they have to buy cars and trucks and all these things. And so they're actually required to pay HST. But HST is something called a consumer tax. So HST itself is a consumer tax, okay? Meaning that businesses are actually HST exempt. So when a business pays HST, they actually get that money back from the government. So all businesses are entitled to recover the HST that they charge by their suppliers. They can recover that money from the government. This HST paid is recorded in what we call a contra liability account. The word contra means opposite. So we know that normally liabilities have a credit balance, but a contra account is opposite. So a contra account will have a debit balance. Now, HST recoverable or HST receivable is a debit balance, but we find it in the liabilities section. And I'm going to explain why in a second. So let's say we bought some office supplies for $648. That's not what we're going to pay. We're going to pay more than that. We're going to pay $732 because we're going to take the $648 and multiply it by 13%, and we're going to pay $84 in tax. But we can get that money back from the government. So we set this money aside in this other account that's a contra liability account that's going to have a debit balance. This is always going to have a debit balance. And this is money we're going to get back. Okay, so the total amount we paid for the supplies was $732, but we only debit the supplies account for the $648, which is the true value of the supplies, right? Because the tax doesn't add any value. Okay, so in your textbook, at the end of 6.3, you're going to have a chart that looks like this, and it's got the perfect HST example. So anytime you make a purchase, okay, so anytime you make a purchase, your transaction is going to look like this. Anytime on account, anytime you make a purchase for cash, your transaction is going to look like this. Anytime I sell something on account, the transaction will look like this. And anytime I sell something for cash, the transaction is going to look like this. So please make sure that you're referring to this when you're doing your transactions from this chapter. Now, at the end of the month, or the end of the quarter, or the end of the year, the business is required to remit the HST to the government. How do we do that? Well, we need to file what's something called an HST return. Okay? We need to file an HST return either monthly, quarterly, or annually, and we must file it within 1 month of that reporting period. And at that point, the business will clear or zero out, okay, zero out their HST accounts. So what we're going to do is whatever the value is in the HST payable account on March 30th, we're going to debit that at the end of April. We're also going to credit HST recoverable because it normally has a debit balance, okay? So we want to zero it out, and the way we zero it out is we credit it. So we debit HST payable, we credit HST recoverable, and the difference is the amount we owe to the government. So this is what we owe, this is what the government owes us, and the difference is what we take out of our bank account and send into the government. So this is how we do the quarter ended for March 31st. So the example again in the back. to zero out the HST payable and the HST recoverable accounts, we need to do this. We need to debit the HST payable because it normally has a credit balance, so we want to do the opposite. And we also need to credit the HST recoverable account because normally it has a debit balance and we want to zero it out. So here you can see this should have a debit here and then a credit here. Okay, and so we debit this account and we credit this account, and the difference is the amount that we remit to the government. Okay, so I want you to think about it like this. Let's pretend that you owe me $20 for your workbook. And then I see you later on in the cafeteria and I forgot to bring my purse down and I ask you if I can borrow $5. And you say, yeah, no problem, Mr. Chkowski, I'll totally give you $5. Later on, how much are you going to pay me? Hopefully you said $15, right? Because you owed me 20, I owe you 5. Rather than exchanging a 20 and then a 5, why don't you just pay me 15? And that's exactly what's happening here. We owe the government $8,250. The government owes us $1,100. So the difference is the amount that we actually pay. So now our balance sheet for the liability section is going to look a little bit different. The HST recoverable is recorded in the balance sheet as a contra liability account, and this is how it's going to look. So we'll have our liability section, we'll have our regular accounts payable. This is going to be in column 2, okay? And then we have our HST payable and our HST recoverable. So we're going to record that in column number 1. So HST payable is $2,309 and HST recoverable is $1,567, and the difference is $741. And we're going to write that right beside that value in HST recoverable. So we're going to subtract these two numbers, it equals that, and we're going to write it here. So then our bank loan is added, and finally we calculate our total liabilities by adding all the amounts in column 2 and recording that answer in column 3. Thank you so much for listening. Hopefully this isn't too confusing. If it is, go back and watch it again. Thank you though so much for making it to the end of the video and sticking through it. I am going to show you more examples in class tomorrow. All right, have a good night. The back of your textbook is this, and our goal is to zero out the HST payable, and to do this we need to debit the HST payable account and we need to credit the